Welcome to Financialize. My name is Iron, and I will be your guide through this series of articles and videos created to expand your mind on the topic of finance and the economy. Throughout our content, we will focus on common misconceptions, distractions, established theories, and from time to time, the occasional equity analysis. Today, we will focus on the CPI, or what we know it as, the consumer price illusion. The term inflation has lost its original meaning over the years. When people refer to inflation today, they often think of it as rising prices. However, this isn't the true definition of inflation. Instead, it's a sleight of hand that disguises the real cause of inflation and distracts from the fact that it functions as a hidden tax. In our previous article and video, Financialization, the wrecking ball of the economy, we discussed how increasing financialization diverts capital into non-productive assets, leading to minimal real output. This misuse of capital is a major driver of inflation, funneling scarce resources into unproductive assets. Thus, excess financialization is a driving force of inflation. It takes what would otherwise be scarce capital and funnels it into non-productive assets or businesses. Now, the situation is exacerbated because we are not just using excess savings, which we have none of, but instead are expanding the money supply with quantitative easing, QE, or not QE, as the Fed likes to call it. This expansion directly causes inflation, whether it inflates asset prices or consumer prices. Inflation, in essence, is the same irrespective of its form. Back to the illusion. The Consumer Price Index, CPI, is significantly understated. There are several factors and moral hazards contributing to this understatement, which we will cover in a future article and video titled Shrinking Inflation. Let's first discuss a few ways the CPI is artificially kept low. The three major contributors to this are hedonic adjustments, substitution, and a combination of useful life reduction and shrinkflation. Hedonic adjustments supposedly account for product improvements. For example, if a cell phone cost $1,000 last year and $1,100 this year, that's a 10% increase. However, through hedonic adjustments, the real inflation rate might be calculated as 5%, or even a deflated -5%. This is done by considering improvements, like longer battery life or clearer pictures, as added value, thus offsetting the price increase. While significant improvements may justify such adjustments, it's hard to argue that hedonic adjustments aren't used to skew price increases, as we even see these adjustments applied to items like newspapers, magazines, or the new microwave that breaks after just a few years. More on this one later. Substitution works, as its name implies. As prices increase, the mix of items in the CPI basket changes. For example, if the price of beef rises 25%, but chicken only 10%, the calculation assumes consumers will switch from beef to chicken. Consequently, the reported inflation rate for meat goods is only 10%. This manipulation is a far cry from the actual inflation experienced by everyday consumers. The calculation essentially says that because of this pricing difference, consumers will no longer purchase beef and then instead substitute that purchase with additional purchases of chicken. If making improvements reduces inflation, then reducing quality or quantity adds to it, doesn't it? Nope, not even a little. In fact, not at all. Neither of these rational concepts are taken into account with the CPI. Remember that old microwave, dishwasher, or fridge your grandma had and it still runs today? Yet the one you bought less than 5 years ago breaks, and it seems to happen every 5 years. Well, there should be a revision to increase its actual price because you have to buy it 5 times as often over the same product lifetime. Right? What about that family-sized bag of chips that's now normal size? If you now have to buy 2 bags to equal the old bag size, isn't that a 100% inflation rate? These two facts, which I would argue would raise the CPI higher than hedonics and substitution changes, aren't even calculated at all. For those intrigued or angered by these adjustments, I recommend checking out John Williams' work at shadowstats.com. This site provides an alternative look at CPI data, money supply growth, unemployment, and more. Some might think these manipulations are a thing of the past, but they continue today. Remember the supply chain disruptions? To mitigate rising inflation numbers, The Fed and other central banks recently changed the calculation method again. Instead of using a 2-year history for price increases, they now use a 1-year period, conveniently lowering the average. The biggest illusion of it all isn't even the CPI itself. It's the idea of the dual mandate. I'm sure you have heard of it, full employment and price stability. Full employment makes sense, but what does price stability mean? According to the Oxford Dictionary, stable means not likely to give way or overturn, firmly fixed. Are you telling me stable isn't prices increasing at the 2% target indefinitely? Or to think about it another way, prices doubling every 35 years? That doesn't sound too stable. Please join us as we traverse this landscape of financialize or financial lies. We are here to invoke your thoughts on the world in front of us all. In the end, we are not here to convince you that these are lies, but rather show you the other side of finance that has been hidden from you. In the end, you will decide if these are financial lies or not. Please support us by following us on X, YouTube, Patreon, TikTok, and Substack.